Hello friends, today's topic, beware our markets are presently overvalued, a report. The idea of this video is only to inform you, not to threaten you. My name is Dr. Bharath Chandra. The videos are meant for the benefit of society. Nifty has been one of the world's best performing indices in 2022 and has beaten many global and emerging market countries like Brazil, UK, Japan, China, US, Korea and Taiwan. Two common valuation indicators are hinting that the market may have gone up too much. By knowing about these valuation indicators, we may be able to understand how market may perform in the next 6 to 12 months. First indicator is bear indicator, bond equity earnings ratio. Bear indicator is the ratio used to evaluate the relationship between bond yields and earnings yield from stock markets. It gives an idea whether it is better for institutions to invest in government bonds or stock markets. Government bonds give safe returns and their returns don't fluctuate too much compared to stock market returns. Currently, the yield from government 10-year bonds is 7.23% per annum. So the bond yield is 7.23% as of now. Equity earnings yield is the inverse of PE ratio. PE ratio is equal to price of the stock index divided by earnings per share. Equity earnings yield, earnings per share into 100 and divided by price of the stock index. Equity earnings yield for Nifty 50 is equal to Nifty earnings per share into 100 divided by Nifty index level is equal to 825 into 100 and divided by 18,400 is equal to 4.48%. So their ratio bond yield divided by equity earnings yield is equal to 7.23 divided by 4.48 is equal to 1.61. Their ratio, the valuation and the inferences are as follows. Below 1 means stock market is undervalued, stocks are more attractive than bonds. 1 is equal to stock market is fairly valued, stocks and bonds are equally attractive. Above 1, stock market is overvalued, bonds are more attractive than equities. If you want to make money in tons and thousands, then you have to understand the value of long-term investing in stock markets and you got to learn fundamental analysis. If you want to make money on short-term, monthly, etc., then you must learn technical analysis. And to give more details about our 3 months online stock market course in Canada, we are conducting a special introductory webinar on 18 December Sunday from 4 p.m. to 6:15 p.m. and this is an online webinar. If you want the link, it's very easy. Send us an email successdigest@gmail.com, name, mobile number and the subject is Kannada webinar. The second indicator I am going to talk today is Buffett indicator or market cap to GDP ratio. Warren Buffett, one of the richest men in the world and one of the most successful investors, had created an indicator many years back called Buffett indicator. This indicator gives an idea whether stock markets are overvalued or undervalued. Buffett indicator valuation is like this: below 100% undervalued, 100% fairly valued, above 100% overvalued. Currently, market cap of Indian stocks is 292 lakh crores. India's GDP is 254 lakh crores. So Buffett indicator, market capitalization of stocks into 100 and divided by GDP of the country is equal to 292 into 100 divided by 254 is equal to 115%. So as per Buffett indicator, Indian markets are looking overvalued. But Indian markets have been overvalued based on this indicator since end of 2020 itself. In spite of that, markets have rallied since then. In the peak of January 2008, the Buffett indicator for Indian stock markets was 160%. But the long-term average, 10 years of Buffett indicator for Indian markets is 80%. So, as per both Bear and Buffett indicator, Indian markets are overvalued. This is the reason many institutional investors are cautious to invest in Indian markets currently. The ratio is more favorable in other Asian countries such as China and South Korea as of now. Now the main question is, what can the investors do now? If your vision in stock market is minimum 8 years, then these indicators will not matter since you will be investing regularly over a long period. Hence, continue investing in good stocks. However, you must note that stock markets will not do well in each and every year. Hence, you have to have the patience. Finally, at the end of the video, if you learned something new today, type new in the comment section. If you are not the member of Stock Market Academy channel, this is the time to subscribe, press the bell icon, send this video to all your friends, and finally, thank you for watching the video. Bye bye, all the best.